it starts with asset allocation. And asset allocation is something that should fit one investor's needs. And very important, the first step of asset allocation, the strategic step, should come to an asset allocation breakdown which the investors will be able to live with no matter what happens in the market. So even in the case of an extreme shock, triggering a temporary markdown of portfolio, the investor should not lose sleep over it. Well, markets are subject to shocks every once in a while. The risk premia investors are vesting by investing in bonds, equities, and other type of financial investments fluctuate over time. This triggers ups and downs and mark-to-market volatility in portfolio. And especially in the case of external shocks, which can be pretty extreme, the temporary impact on portfolio can be quite harsh. The other case where portfolios suffer a significant drawdown is when the economy goes into a recession. Whether or not you've been able to protect yourself to a certain extent against that impact, your strategic allocations should be such that you can survive these events in markets. So the first step is, what is my investment objective? Most important part of it is the risk tolerance. So you're going to calibrate the mix as a function of the amount of risk you're willing to take. And then the return of the portfolio will be over time a function of the risk you've been willing to accept or not. Again, it comes down to the questions for each and every one. How much risk am I willing to take? And what should I expect as a return for that given level of risk? There are various ways to build an asset allocation. The one way I've rejected very early on in my career is the backward-looking way, looking at past returns and correlation, mostly because the starting point being different, the outcome will be different, but very critically because all of these models relies on correlation assumption, a high degree of stability in correlation between assets, and history shows that correlations are the exact opposite. They are very unstable. In other words, the way each and every asset class behaves relative to the others is not stable over time. We'd rather take a forward-looking perspective. So it starts with the secular outlook, where we carve out the key structural trends and forces at work in the economy and the markets. We use our capital market assumption, including forward-looking expected return for asset classes. And then we optimize the mix of assets as a function of that forward-looking perspective. The next step then is for each and every asset class composing the portfolio to decide how you're going to implement. Will you pick a fund? Will you pick an ETF? Will you buy direct securities? Will you invest passively? Will you invest actively? In both options, active and passive, you have to choose the right instrument. So then it's about portfolio construction, making sense of the whole portfolio, because the sum of the part is far more important than each and every individual part. If your strategic allocation is well calibrated with regards to your risk tolerance, the longer the time horizon, the better. This is in every investing textbook, right? The matter is, life is uncertain. I think Keynes said in the long run, we're all dead. So I would say people should have a 4 to 7 year time horizon. The paradox being the longer you are patient, the less uncertain investing becomes. But you cannot ask anyone, just wait for 20 years and eventually it will work out. I think it's not, just basically commercially, it's simply not viable, right? Only a pension fund with extremely clear liabilities can do that. So I think for a private investor, a 4 to 7 year horizon is a reasonable, pragmatic time frame. Look, most of the time, it's important to stay the course, stick to your strategy. And then, whether you should act and do something different will be a function of what happened in the market. And I always say an investment manager can only be as good as the opportunity set allows him to be good, right? So there will be opportunities along the way, either to take some profits and reinvest, redeploy capital in other investment in asset classes, or there will be opportunities to rebalance or buy more of what you already own. And that's really the markets which will provide or not these opportunities over time. The volatility regime will be very important. There are times when volatility is low, the dispersion of asset return is rather low, so why would you move? And there are times when volatility is higher, providing opportunities to trade. Rebalancing has the merit of bringing discipline. You could argue someone very young with a very long time horizon could start from half equities, half bonds, and eventually over time equities will outperform bonds and the share of equities will increase. The circumstances of individuals change over their lifetime. Their liabilities, their family, their personal situation change. So I think no rebalancing is not an option either. You should revisit fundamentally your strategic allocation once a year. Again, the secular outlook, I cannot emphasize enough, is key. Understanding what are the structural trends. You position accordingly, and if you rebalance, certainly the frequency of the rebalancing should be maximum once a year, and preferably not on the end of the year, more like June 30, the way endowment funds typically practice rebalancing. The current climate is a very special, very unique set of circumstances. The overarching issue is financial repression. Financial repression finds various means of essentially transferring capital from the private to the public sector, from creditors to debtors. Zero or negative interest rates are one of these ways of transferring wealth from the first to the second category. And there is a pretty extreme risk aversion at the moment in the investors and clients community to mark-to-market volatility. People prefer to sleep very, very well, sitting on short duration, cash-like instruments in low or negative yielding currencies, rather than experiencing the short-term ups and downs of a reasonably invested portfolio with a defensive profile. So typically we have a historical precedent, Japan, where interest rates have been zero or negative since 1999. It's actually the 20th anniversary of negative rates in Japan. And what you see is that, back to the time horizon issue, if you take a 5-year rolling window, the worst 5-year rolling return of a mix of Japanese government bonds and Japanese equities, weighted 75%, 25%, has been minus 1.7 annually compounded. It's not much worse than zero or slightly negative interest rates, whereas the best period has been 6.9 annually compounded over 5 years. And of course, the total return of the portfolio over the period has been significantly positive, much better than cash. And the conclusion from this is the price of short-term tranquility is probably quite expensive over the medium to long term. I think it's important to calibrate your asset allocation as a function of your risk profile. And it's not a scientific calibration. Emotions play a role in this. You should be able to stick to your asset allocation no matter what happens, no matter how bad the market can be in the short run. That's the most important point. The second point, don't spend too much time predicting the future. The reasons why you have to diversify is because the future is unknown, is very uncertain. So you want to spread your investment reasonably. You don't need to overly diversify, but you want to spread your investment over different type of risk premia, different type of asset classes, which together are a better mix than standalone. And then stick to it. Don't overreact to the news. Look at your portfolio maximum once a quarter is more than enough. And every once in a while, when there is one such opportunity in market, there is a big shock, then really take advantage of it, take a view. But most of the time, start from the principle that you don't know what happens tomorrow.